Employee Stock Options, by www.optionstradingeducation.com. Employee stock options can dilute the value of the stock of a company. The current example is the recent initial public offering by LinkedIn. The company went public last week. A concern going into the first day was that LinkedIn has a large number of employee stock options outstanding. This is common in Silicon Valley firms as it allows the companies to attract outstanding young talent for a lower wage that they otherwise might have to pay. The attraction is that if the company does well, like Google, Microsoft, or recently LinkedIn, the stock options can become very valuable. The problem for stock investors is that as employees cash in their stock options, it can represent a substantial drag on cash flow. In the case of LinkedIn, estimates are that outstanding employee stock options amount to nearly a fifth of the value of the company. For those interested in standard options trading, how to trade stock options includes keeping track of employee stock options and their potential to dilute stock value. What are stock options worth on LinkedIn? Trading in standard options on the stock will start shortly. Apparently, stock investors took little notice of the large number of outstanding employee stock options at LinkedIn as first-day trading rose as high as 140% over its opening price. When standard options trading opens in a few days, traders will assess the likelihood of a further rise in stock price versus a correction after the initial excitement. Options trading of LinkedIn may be a more risk-free endeavor than directly buying or selling the stock. The buyer of a call or put contract on the stock will be under no obligation to exercise the options contract and will only do so in the event that the stock price moves as he expects. By trading options on the stock, the options trader will be able to leverage his investment as he need only pay the premium need to buy a put or call on the stock. Should he succeed in anticipating a large price swing, the options trader need only exercise the opposite trade in order to profitably exit his options contract. As such, he will never pay the price of the stock. Those holding employee stock options are essentially holding call options, except that they have paid the premium on the contract by working for the company. Unlike call contracts, employee stock options typically do not have an expiration date. Thus, the employee can wait for months or years until he or she decides to cash in on the high stock price or take a partial payment in the form of stock options in order to make an unrelated purchase. Standard options traders will want to watch when the principals of the company choose to exercise stock options, as they may well do so when they expect the stock price to fall. When to buy puts on LinkedIn may be just as the last anxious investor antes up his hard-earned cash in hopes of a continued rally. It may also be when all of the officers and large holders of employee stock options choose to exercise their rights and take cash. For more insights and useful information regarding options and options trading, visit www.optionstradingeducation.com.